A staggering $1 trillion order pipeline shocks the market, and a $20 billion acquisition of Groq. Jensen Huang is using a 35x performance leap to personally shut down every argument about an AI bubble, yet somehow, this global compute money printing machine is trading at just 1x earnings and being labeled as average, with a $380 price target in sight. Is this pullback just a technical, or is there a once-in-a-decade buying opportunity? Hey everyone, welcome to Stock Market Breakdown. When you look at Nvidia today, you can't evaluate it as just a hardware company anymore. Jensen Huang's announced $1 trillion order pipeline isn't just a bigger number of signals, a full acceleration of global AI infrastructure demand. And after acquiring Groq, Nvidia has evolved from the king of training into the dominant force in inference. What's even more surprising is that its valuation is actually 24% lower than the industry average. Jensen Huang recently revealed the cumulative order intentions for Blackwell and the latest Vera Rubin architecture are expected to reach an astonishing $1 trillion by 2027. This figure is double last year's estimate, completely crushing concerns about a slowdown in AI investment. If we apply Nvidia's consistent 75% gross margin, this implies an unprecedented level of profitability in human business history. Accelerating demand is pushing Nvidia into an entirely new compounding cycle. What does $1 trillion really mean? That's equivalent to the annual GDP of many developed countries. The key insight here is that AI compute is no longer experimental. Spending is becoming a survival tax for global tech giants. As long as margins stay near 75%, every chip Nvidia sells generates massive free cash flow. In late 2025, Nvidia spent $20 billion to acquire Groq and quickly launched the Groq 3 LPU chip. This product delivers a 35x improvement in tokens per watt performance compared to the Rubin GPU. It directly tackles one of AI's biggest challenges, energy cost. With this kind of efficiency lead, Nvidia has built a massive competitive moat in the inference market, leaving competitors with virtually no room to respond. Groq's tech getting absorbed by Nvidia is like a max-level player picking up a legendary weapon. A 35x efficiency gain means AI operating costs could drop by over 90%. In inference, cost is everything. Nvidia used to dominate by being fast, now it's also the most efficient. Groq 3 LPU effectively lowers the barrier to large-scale AI deployment while pushing competitors into a corner. AI training is typically cyclical capex, but inference is recurring, ongoing spending tied to real-world usage. By integrating Groq's technology, Nvidia now controls the full stack from training to inference optimization for hyperscalers. Nvidia's solution not only speeds up deployment, but also saves billions annually in operational costs. This shift toward inference makes Nvidia's revenue more stable and recurring. You have to understand the value of recurring spend. Training is buying the shovel once, while inference is paying a toll every time someone uses AI. As global AI adoption explodes, inference will become much bigger than training. Nvidia's full stack control turns it from a hardware vendor into an energy management platform. That evolution is what supports its long-term valuation. While Amazon, Google, Microsoft, and Meta are all developing their own AI chips to reduce dependence on Nvidia, Nvidia maintains its lead through relentless innovation speed. In-house chips typically take 2 to 3 years to develop, but Nvidia keeps pushing the finish line forward with breakthroughs like Groq 3 LPU. By the time competitors catch up to older architectures, Nvidia is already far ahead with next-gen performance. While others are building chips in the lab, Nvidia is launching new breakthroughs every year. The speed of internal chip development simply can't keep up with Nvidia's execution. As long as Nvidia maintains this rapid iteration cycle, competitors' cost advantages will get wiped out. This asymmetric competition keeps Nvidia firmly in control of high-performance computing. Despite being the clear leader in the AI boom, Nvidia currently trades at around 1x forward divided by nearly 24% below the industry average. Analysts believe the market still views Nvidia as a cyclical hardware company, underestimating its identity as a high-growth platform business. This disconnect suggests a significant valuation gap to 1x earnings for a company doubling profits with a $1 trillion pipeline. That's where in financial history, plenty of average consumer stocks trade at 5x. The market is still using an outdated lens. Investors fear a cyclical peak, but in reality, AI infrastructure is just getting started. The gap in perception is where the opportunity lies. Among 49 analysts covering Nvidia, the consensus rating is a rare strong buy with a score of 4.82. The highest price target sits at $380, implying over 120% upside from the current $172 level. Despite macro volatility, institutional confidence remains strong, with capital flows showing consistent buying during pullbacks. A 4.82 rating is about as bullish as it gets. The 120% upside is a randomized build on the $1 trillion pipeline and growth-driven profit re-rating around $170. The stock already reflects macro fears, but not future earnings growth. Year to date, Nvidia has pulled back about 7.4% due to interest rate expectations and tech sector rotation, but this is not a fundamental breakdown. Instead, it presents a strategic entry point. One approach is using cash-secured puts to generate income while waiting for a better entry price. If assigned, you acquire shares at a discount. If not, you keep the premium, creating a more disciplined strategy in a volatile market. To sum it up, Nvidia is a dominant powerhouse currently sitting in a valuation pocket. The $1 trillion pipeline is its foundation, and Groq is its weapon. So what do you think? Those 1x earnings represent a massive opportunity, or is the market pricing in risks we're missing? Would you go all in here, or scale in using option strategies? Drop your thoughts in the comments, and don't forget to like and subscribe. I'll see you in the next one.